everyone, and welcome back to Boni's Life. The crypto market never sleeps, and the last 24 hours have been a roller coaster of geopolitical drama, institutional chess moves, and some serious price action. Today, we're going to cut through the noise. We'll break down exactly what happened, why it happened, and most importantly, how you can strategically trade the next 24 hours. We've got expert commentary, deep technical analysis, and some surprising stories you won't want to miss. So grab your coffee and let's get into it. First, let's get a snapshot of the market. Over the past day, the global crypto market cap has taken a hit, sliding about 3% to rest around the $3.1 trillion mark. It's been a sea of red, with about 95% of all crypto assets seeing a downturn. Bitcoin, our market leader, has been volatile, dropping from highs above $95,000 to a low around $90,600. As I'm speaking, it's hovering in that low $90,000 range, erasing all the gains we saw earlier in January. Ethereum has followed suit, dropping about 5.7% to around $3,030, and major altcoins like Solana, XRP, and Cardano have seen similar or even steeper losses. This tells us that investors are feeling a bit skittish, rotating out of higher risk altcoins and into the relative safety of Bitcoin, or even out of the market altogether. So, what's causing this fear? The big story, without a doubt, is the return of trade war rhetoric. President Trump has threatened to impose new tariffs on several European nations, including Denmark, Germany, and France, over a dispute related to Greenland. This isn't just political noise. It has real-world consequences. The last time these tariff threats emerged, we saw a massive market reaction, and this time was no different. In just 24 hours following the announcement, the crypto market saw over $875 million in liquidations, with a staggering 90% of those being leveraged long positions. Essentially, traders who were betting on the price going up got completely wiped out. This geopolitical tension is happening while the world's financial and political elite are gathered in Davos for the World Economic Forum. The theme this year is a spirit of dialogue, which is a bit ironic given the trade war talk. President Trump is expected to meet with global CEOs, and we're already seeing key crypto figures there, like Coinbase CEO Brian Armstrong, who is working to push forward the US crypto market structure bill. The headlines coming out of Davos in the next 24 hours could inject some serious volatility into the market. Interestingly, while crypto is down, gold has been surging to new record highs, up over 70% in the last year, reaching nearly $4,700 per ounce. This suggests a classic flight to safety. However, some analysts are pointing to a fascinating pattern they call TACO, which stands for Trump always chickens out. The theory is that these aggressive tariff threats are often a negotiating tactic and are dialed back later. Matt Howells-Barbie, a VP at Kraken, noted that the relatively modest 3.5% pullback in Bitcoin, despite the scary headlines, might suggest that seasoned traders are betting on a de-escalation. It's a high-stakes game of chicken, and the crypto market is caught in the middle. This brings us to what the big players are thinking. Stefan Lutz, the CEO of BitMEX, put it bluntly: trade wars are back on the menu. He believes the market has acted exactly as you would expect in the face of this geopolitical disquiet. Jacob Joseph, a research analyst at CoinDesk, echoed this, stating that the risk-off sentiment has weighed on broader traditional markets, with spillover effects into the digital asset sector. Jonathan Randin from Prime XBT added crucial context. The initial 3% decline triggered $865 million in liquidations within 24 hours, with 90% coming from over-leveraged longs. Large holders have been moving coins to exchanges at the highest rate in 10 months, and we saw ETF outflows of nearly $400 million after $1.7 billion came in earlier in the week. But it's not all about the macro environment. There's a deeper structural shift happening in the crypto market. The market maker Wintermute recently declared that the traditional 4-year Bitcoin halving cycle might be dead. Historically, Bitcoin would rally post-halving, and the profits would rotate into Ethereum, then other altcoins, creating a market-wide alt season. Wintermute argues this mechanism is now broken. Why? The rise of institutional products like Bitcoin ETFs. These products act like walled gardens, providing sustained demand for large-cap assets like Bitcoin, but not naturally rotating that capital into the wider market. This explains why altcoin rallies in 2025 were so short-lived, averaging just 20 days compared to over 60 days in 2024. This institutional adoption is a double-edged sword. On one hand, it brings massive capital and legitimacy. We're seeing BlackRock make huge moves, investing $380 million in MicroStrategy preferred stock and filing for a massive Bitcoin premium income ETF. JP Morgan is even planning to accept Bitcoin and Ether as collateral. On the other hand, it changes the market dynamics that many retail traders have come to rely on. Greg Cipollaro from NYDIG Research points to the political instability in the United States as a key driver, drawing comparisons to Nixon's pressure on the Fed before the 1972 election. He notes that political meddling in monetary policy is almost invariably bad. Higher inflation, damaged central bank credibility, and weaker currencies are typical byproducts. Bitcoin, as a non-sovereign asset with a fixed supply, may be benefiting from investor concerns about similar risks. On the regulatory front, there's a glimmer of hope. SEC Chairman Paul Atkins has confirmed that the Digital Asset Market Clarity Act is nearing the finish line. This bill aims to end the turf war between the SEC and the CFTC, providing clear rules for which agency oversees which type of digital asset. The CFTC would oversee digital commodities like Bitcoin, while the SEC would regulate investment-style tokens. There's even a maturity clause that would allow tokens to transition from SEC to CFTC oversight once their blockchain becomes sufficiently decentralized. This is the kind of clarity the industry has been begging for, and it could unlock a new wave of institutional investment. As one observer noted, clear rules don't slow innovation. They let real infrastructure scale. US banking regulators are also signaling a more open posture. The Office of the Comptroller of the Currency has approved 5 applications for national trust banks to engage in digital asset activities, including Fidelity Investments. They've issued interpretive letters confirming that national banks can purchase and sell digital assets in custody, pay blockchain network fees, and engage in riskless principal transactions. The Federal Reserve has rescinded its restrictive 2023 policy statement and replaced it with a more permissive one. This is a significant shift that could open the floodgates for traditional financial institutions to enter the crypto space. Looking at the technology itself, Ethereum co-founder Vitalik Buterin has laid out an ambitious roadmap for 2026, calling it the year to take back lost ground in terms of self-sovereignty and trustlessness. He's focused on making it easier for everyday users to run their own nodes through zkEVM technology, enhancing wallet security with social recovery, and improving privacy for transactions. He also warned that Ethereum's growing complexity threatens its 100-year future, proposing a garbage collection approach to streamline the codebase. This is a reminder that the core ethos of cryptos and decentralization is still very much alive and being actively developed. In a fascinating real-world application of this tech, we just saw the first ever confidential payroll processed on the Ethereum mainnet. Using fully homomorphic encryption, a company called Boni was able to pay its employees in a confidential version of USDT, where the transaction amounts are encrypted but still publicly verifiable on the blockchain. This leverages the new ERC 7984 standard and demonstrates that privacy and compliance can coexist on a public network. It's a huge step forward for enterprise adoption of crypto. All right, let's get to the part you've been waiting for, the trading strategy for the next 24 hours. Given the extreme fear in the market, with the fear and greed index at 20, this is a time for caution but also for opportunity. For Bitcoin, the key levels are clear. We have a major support zone between $89,200 and $90,500. This is the line in the sand. On the upside, we face a wall of resistance between $94,000 and $94,800. A break above this level is the first bullish sign. So here are the technical triggers to watch. A bullish trigger would be a decisive break and hold above that $94,800 resistance level, especially on increased volume. This would open the door to our next major resistance zone around $98,300. Watch for the RSI to recover above 50 from its current level, around 41, and look for a MACD crossover into positive territory. Conversely, a bearish trigger would be a sustained break below the $90,500 support. This would signal further downside, with the next logical target being the support around $89,200 or even the early December level at $83,871. Here's a potential strategy. For the bulls, you could consider entering a long position if the price dips into the support zone of $89,500 to $90,500 with a tight stop loss just below at $88,000. Your first take profit target would be around $93,500 with a second target at $94,766. This gives you a risk to reward ratio of about 1 to 2.5. For the bears, you might look to short a rejection from the resistance area around $93,000 to $94,000 with a stop loss above $95,500, targeting a move back down to the $90,500 support. That's also roughly a 1 to 2 risk to reward setup. For Ethereum, the picture is a bit more bearish as it has been underperforming Bitcoin. It lost its key support at $3,200, which now acts as resistance. A bullish trigger for ETH would be to reclaim that $3,200 level with conviction, which could target $3,350 to $3,400. A bearish trigger would be a drop below the psychological $3,000 mark. A possible strategy here is to wait for a clear signal. A long entry could be considered on a dip towards $2,950, with a stop at $2,850, while a short entry could be triggered by a failure to break above the $3,200 resistance. Remember, risk management is paramount in this environment. The headlines from Davos can cause wild swings. Use stop losses, don't over-leverage, and consider scaling into position rather than going all in at once. Position sizing should be no more than 2 to 3% of your portfolio per trade. The $865 million in liquidations over the past 24 hours is a stark reminder of the risks of being caught on the wrong side of a move. Also, keep an eye on whale movements. Large holders have been moving coins to exchanges, which often precedes selling pressure. So to sum it up, the market is on a knife's edge, caught between geopolitical fears and the promise of institutional adoption and regulatory clarity. The next 24 hours will be crucial. Watch the technical levels we discussed, keep an eye on the news out of Davos, and trade smart. The taco pattern could provide a surprising reversal, but hope is not a strategy. Stick to your plan. Key events to watch include Trump's address at Davos, any tariff de-escalation signals, morning ETF flow data, Federal Reserve commentary, and the return of liquidity when Asian markets open. That's all for today's episode of Boni's Life. I hope this analysis helps you navigate the exciting and challenging world of crypto. If you found this valuable, please hit that like button, subscribe to the channel, and let me know your thoughts in the comments below. What are your price targets for Bitcoin this week? Do you think Trump will follow the taco pattern? Drop your predictions in the comments. Stay safe and happy trading. I'll see you in the next one.